Welcome everyone to Tax Talk Canada, where we answer your biggest tax law questions. Today, we're speaking with Charles Hayworth, a partner at Radnoff Haworth. Charlie, a question we often get from our subscribers about tax law is, what are the most common tax loopholes?
Tax loopholes isn't probably the best phrase to use. There are what I would call scams or schemes, tax schemes, and then there's just using the act itself in the way that it's been written to provide an advantage to your client. So legal, you might call loopholes, but really that's just using the act itself. So there are a number of provisions in the act that might be advantageous. For example, there is, if you can ensure that the property you're buying results in a capital gain, you're going to save 50% of the tax right off the bat. Another legal kind of issue is maybe you're dealing with offshore funds. And if that money's never touched Canada's borders and it goes straight into an offshore trust for you as the beneficiary and it comes from, say, family in another jurisdiction, then you can enjoy the benefits of that 0% tax haven and report all of it to CRA, and it's completely legal and there isn't an issue with it. You know, all of our big banks are there. You've got CIBC, you know, First Caribbean, you've got RBC, this and that. Like, it's all well above board, as it were. So that's the legal kind of loopholes that there are.
So saying loopholes is a misnomer. The best strategy is playing by the rules.
Playing by the rules, exactly. You read the act and then you abide by the act and you do what the act allows, and that's one of the things that it allows.
Now, conversely, what are some common illegal loopholes or scams that are currently happening?
So there are a number of scams, and they normally deal with three things. So there's advice that I will always tell people to ignore, and which usually comes from real estate agents. And that's when, say, mum and dad buy a second property. Real estate agent, or maybe even real estate lawyer, I've had examples of that happening as well, tell them to put the property in the name of their child. And then you can claim principal residence exemption, which means that the second property will increase in value without there being any tax paid. The problem with that is that the child didn't buy the house, and it's really just income sheltering by the parents. And so when CRA find out that that is what has happened, you know, the money comes from the parents, is put in the child's name, the mortgage is paid by the parents, but it's all in the child's name. They will basically, and then the property is sold, they will assess that as income. So that's a huge issue that I deal with, and that's a common thing that is done. The other one is transferring properties into kids' names just before death as part of estate planning to avoid probate tax on investment properties. That results in a deemed disposition that people don't really know about. So that results in a big tax bill, and that can get really out of hand when the accountant doing the estate tax returns doesn't know about that. So that can result in big bills being sent from CRA, big reassessments. And then the third thing that I deal with often are tax shelters. So this is where things get a little bit weird, because weird's not the right word, a little bit grey. So tax shelters are legal under the Income Tax Act as long as they fulfill a number of requirements. And CRA even provides like a T number, it's not a T number, but basically a tax shelter number to tax shelters that have registered themselves with CRA. So what a lot of fraudsters do is they use the fact that they have a CRA tax shelter number, and then they just create this web of limited partnerships and corporations and et cetera, and just basically create fictitious business losses. And then they sell those fictitious business losses to the people who are investing in the tax shelter. And so that's another issue. So people might put in $50,000 into actual real money into one of these tax shelters, thinking it's legitimate, when the whole thing's a big, fraudulent, fictitious mess. And then when CRA comes along and reviews the tax shelter, they find out that it's just a fraudulent mess. And all those losses, you might have received $150,000 of losses to apply against your taxes over X amount of years from this tax shelter. They all get revoked, and my clients end up with a massive tax bill because it's just basically a giant fraud.
Charlie, thank you again for your time today and your great answers. I'm Brianna Fox, and this has been a Tax Talk Moment.